Capitec is in big trouble, and it's in big trouble because of something known as credit impairments. Capitec is now South Africa's largest bank with over 20 million clients, meaning that it's very vulnerable to what happens to the savings, the income, or anything that relates to those particular clients as well. And it has been affected quite drastically by credit impairments, which have soared by 80% from what they previously were in the year before to 6.3 billion. Now, what are credit impairments? What are they? If you've never heard this before, credit impairments refer to a deterioration in credit quality or the credit worthiness of a borrower. A deterioration in the credit quality or the credit worthiness of a borrower. Now, this can occur for a variety of reasons, including financial difficulties, changes in economic conditions, or personal circumstances. When a borrower experiences credit impairment, it typically leads to an increased likelihood of defaulting on their loan or their credit obligations. Now, there are 5 ways that credit impairments can manifest. Number 1, missed or late payments. Number 2, default. Number 3, a restructuring of loans, where a lender agrees to modify the terms of a loan to make it more manageable for a borrower experiencing financial difficulties. And then charge-offs. Charge-offs are when a lender determines that a debt is unlikely to be collected and removes it from their books. It's considered a charge-off. This action of a charge-off usually occurs after several missed payments and can be an indicator of credit impairment. And then finally, the 5th one is bankruptcy. Filing for bankruptcy is a legal process that helps individuals or businesses that are unable to repay their debts. It's a clear sign of credit impairment and can have lasting effects on a borrower's credit worthiness. So those are the 5 ways in which you can have credit impairments, and they've gone up for Capitec by 80%. That's significant. Now, credit impairments are important to lenders. They use this information to assess the risk associated to lending to a particular borrower. And a borrower who has a history of credit impairments may face higher interest rates or difficulty in obtaining new credit. And linked to that, Capitec now has an approval rate of 45% on loans, which is its lowest level ever. So think about that, 20 million clients, and about 12 million of them are not eligible for loans. That's the asset base that Capitec is sitting on. But this also is a reflection on the state of the economy and also on the state of the working and middle class in South Africa. In February, there was other data that came out from Debt Busters, and they do a debt index. And that debt index showed that South African consumers are under increasingly high levels of financial pressure, with spending power among the middle class being eaten away by the rising cost of living. According to Debt Busters, things have deteriorated so significantly compared to when they started doing this kind of study in 2016. They say that purchasing power has depreciated by 33%. That's significant. And if you then look at all of the factors, including cumulative inflation, it shows you that this is actually not a good time. One of the most worrying statistics that they presented was that South Africans now spend 63% of their take-home pay servicing debt. 63%. So if you link those two together, the increase in credit impairments and the fact that right now take-home pay, 63% of it is going towards credit payments. That shows you that the buying power of the average South Africans has depreciated. What are the impacts on the economy? When there is less disposable income in an economy, when more money is going towards the basics, what that means is that people are not likely to buy books, they're not likely to go to restaurants, they're not likely to buy fridges, TVs, etc. So consumer durable goods are affected, the car industry is affected, etc. So you don't have a lot of that. And what that means is that there's lower spending in the economy, and that means that there's lower growth in that particular environment. Already the growth was projected to be close to 1%. But if you're looking at all of this, you can see that it may even be lower than that by the end of the year. When Easter happened, the Easter break, typically there is a large amount of traffic that goes to KwaZulu-Natal. But when you were following the news around this, and if you had an opportunity to take that trip, you would find that actually this Easter, there wasn't a lot of movement. People didn't go home. They didn't go to Eastern Cape. They didn't go at eThekwini. They didn't go anywhere from Joburg, which is something that typically happens. And that's an indication that people are really struggling. And when you then factor in that the latest inflation data that came out shows that inflation's gone up again, this really is a worrying thing for policymakers and also the banking system, because when you begin to see this kind of strain in South Africa's largest bank, that really is something that is a cause for concern. So I hope you learned something today about credit impairments, and I hope you're thinking about your finances and broadly the finances of South Africa. This really is a tricky time. This is a tricky time, and obviously a reflection on the fragility of the market. Thanks.